ladies and gentlemen. I'm about to teach you order blocks and liquidity zones. What is an order block? An order block is a point in the chart where large funds enter their trades in the market and leave clues for us to know when they will enter again in the near future in price action. For us traders to see when, we usually know them as the last down close candle in an uptrend started the move. Vice versa, in a downtrend we see them as the last up candle in a downtrend. Let's rehash a bit. An order block, right? In a bullish market, right, the market is moving in a series of higher highs to lower highs, higher highs to lower highs, right? And on a specific low, the market will start buying, right? The market, when it buys, it leaves clues for us to know when are we going to enter the market again in the near future. It will leave a down candle in a bullish market. Likewise, in a bearish market, the market will leave an up candle when it's trending lower. The characteristics of a downtrend is that the market is making new lower lows, and as such it leaves lower highs. Those lower highs are points for us to actually find our next opportunity for us to be a seller in the market. Here is an illustration of how an order block usually looks like. There is a last down candle represented by the red candle. The candle has an open, the candle has a close. The candle, after it, there's a big bullish strong move, right? That bullish strong move is our clue, our telltale signs that this is a valid order block, because the market left that zone. That zone for us is our order flow. That zone for us indicates that when the market comes down to that area, will be bias in the market. The institutional traders, the banks, large funds, all had their orders, buy orders, at the last down candle. For us, this is an indication for us to take the market long. Likewise, in a bearish market, we will define our bearish order block as the last up candle before the down move. As such, the market will retrace, correct into what we define as our bearish order block, the last up candle, and start selling from there. That's where we'll be our sellers in the market. I'm going to show you a few examples on the next slide. As we can clearly see by the next slide, that the market was in a bullish movement, right? How do we define that the market was in a bullish movement? We had a low that had a high, then we broke that structure, leaving a last down candle, and you can clearly see that the last down candle is in a circle, right? That circle defines us that is a bearish order block. The market then did what? On the 30th of May, the market corrected, right? It corrected, and when it tapped into the bullish order block, that's when we experienced an impulse in buys. That's when we would have entered our market. Likewise, I'm going to show you an example of a bearish one. In this case, we had a change of character. The market stopped trending upward and started trending downward, and we had a break of a structure. After the break of a structure, the market retraced into our last up candle. on the 11th of May, we can clearly see that there was a last up candle before the down move. Then the market retraced into it. That's when we had our sell entry positions. That, ladies and gentlemen, is an example of a bearish order block. Now, moving on to our next concept called liquidity. There are many ways to define liquidity. One of them is that liquidity is the money needed to move the market, and in this case, who is the money? The less uninformed money, that money is used to draw in traders in the opposite side of the trade. Most often, liquidity acts as our targets to trade towards. Let me define liquidity in an easier way for us to understand. Think of it this way. For you to get price to the upside, what needs to happen? Price has to show us its willingness for it to trade higher. Always remember that in order for there to be a buy movement, there needs to be someone in the opposite side of the market to take the sell. Take it, for example, you're in a market, right? You're going to buy avocados at an avocado vendor. There needs to be a buyer and a seller for there to be a market, right? I go to the market and I sell avocados at 10 rands for 2 avocados, right? Meaning one avocado is, I'm selling it at 5 rand. But me, I went into the wholesaler and I bought the avocado for 2 rands, meaning that I bought at a lower price and I want to sell it at a higher price for me to make a profit of 3 rands. Likewise, in the market, we are building liquidity. We are building liquidity. There needs to be someone at the opposite side of my trade for me to make money. There needs to be a loser for me to profit. Simple as that. Liquidity in this case now says that there were traders in the market that had, in this case, let's say we're in a bullish market, right? There were traders in the market that wanted to sell at a specific high, right? But as we know that the market, the price needs to grow in value. The price needs to go up in value. Meaning that people that entered selling opportunities in the market, they were in for a surprise. Whereas because they sold at a price that was low, you can't, for example, sell at a low price. You're going to make less money. For example, I go into the market and I buy avocados for 10 rands, right? I can't go to the marketplace and sell my avocados for 2 rands. I'm going to be losing 3 rands. That's how liquidity works, right? There's a saying amongst traders that says either you hunt for the liquidity or you are the liquidity. Let me show you a visual representation of what I mean. Take in this case buy side liquidity. There was liquidity resting above the buys, above the highs of the candles. As you can see, that pattern looks like a double top. Then the price did what? Pierce above it, meaning that the people that sold there, they were less informed money. They didn't know that we were in a buy opportunity. We were looking for buys. Likewise, buy stops. There are many people that have buy stops in the market where they have pending orders to trigger them to be people that are going to buy the stops, buy after that high. Here's a visual representation of what do I mean? Liquidity in this case was the double top on the 19th to the 20th of April. We can clearly see that the market made a solid resistance. Then on the 21st and over the weekend to the 24th, the market broke that high, meaning that price seeked to take the price up, meaning that the people that sold there at a price of $1.24.51 were actually selling at a price where it was disadvantageous for them, because the market can clearly see that it was moving in an uptrend, meaning that above the liquidity rests stop losses of traders that were short in the market. Now, buy stops, as you can see here, that the price pierced above it, you see, and most often there will be traders that want to be a buyer above that high, and often the case happens that it will be a false breakout. Then again, let's go to the one for sales. Here is a sell side liquidity. On a sell side liquidity, usually people will see a double bottom and say, hey man, that's a pattern that we all know. We want to be buyers in the market, right? And sorry for them, that's not the case, because they are the liquidity. And likewise, sell stops. People that say, hey, we want to have a breakout after the low, and most of the time they will be trapped. Here is an example of the liquidity, sell side liquidity, where there was relative equal lows on the 16th and 17th of August, and also on the 18th, where it was clearly seen that the market couldn't go any lower. But after the market started looking for sell opportunities, that's where we can clearly see that, hey, the money was actually made for the people that were selling the market, right? And below that, there were sell stops, where the market, people that were having pending orders for sales, had their sell orders triggered, but market decided to buy. And that buy was a correction into what we call an order block, the last up candle. And you can clearly see that on the 30th and the 31st, the market left liquidity in the market. The price left liquidity in the market, equal lows. Then price went up to tap into our last up candle on the 29th. That happened on the 31st of August for it to be sells. And below that, there was sell stops taken out by the breakout traders. So that's in essence how we did it. Thank you guys. That was the end of the slideshow. Now let's go to the chart to look clearly at how we would define order blocks, right? Let's start here. When the market, right, as you can clearly see that the market here had what we define as change of character, right? It is our change of character. Why? Because you can clearly see that the market from the zone was selling, right? But in a way, it was coming to our last down candle, which is here, which is our order block. This is our bullish order block. It is our bullish order block, right? Then from there, we had a change of character, right? And the market left the clue for us. Institutions left the clue for us. Remember, when these guys were here, right? They bought the market. They bought the market. And this is a telltale signs of them getting into the market. As you can clearly see, this up candle. Because it broke this high. It broke this high. Which is a break of a structure, right? Now us, how will we enter the market? Let's assume that there was nothing, right? How will we bias in the market? We'll be biased in the market knowing that once price taps into this down candle, we'll be biased in the market, which happened here. And where will we aim to go? Our target will be this high. It will be our target. And a telltale signs, because above I got here is called buy stops. That will be buy stops, right? We are hunting liquidity, buy stops, right? And you can clearly see that although there was a spike, but that was our liquidity that we wanted. We are hunting this liquidity. Liquidity. Likewise, this one was already taken out. This liquidity was already taken out. This liquidity was already taken out. Why did I say it's already taken out? Because you can clearly see that this candle just above here, this candle just took out this movement here, just took out that liquidity. Now you have a question. I'm sure you have a question that says, hey man, since the market had an order block on the 30th, why did we actually wait for so long? We waited 1, 2, 3 days for us to actually have an entry. That's the thing. The markets, we need to be patient while we trade in the markets. We have to be very specific for us to profit long term into the market, because we can clearly see that from the order block to our first target here gave us 120 pip movement. Then to the upside is 160 pip movement. Let's see how it moves. That movement took a period of 1 day actually, because as we can see that the market here on the 6th to the 7th, that's clearly 24 hours. I'm sure it's like 24 hours. Let's see, from here to here, 27 hours. Let's say 27 hours. We can define this as our setup for a buy trade. We were happy. We were happy, so happy. Then the market is trending upwards, as you can see, right? And in that trending upwards, you can clearly see that there were entries for us to be in the market, right? To enter our longs in the market. You can clearly see this one, it missed it. It happens. It happens. The following day, we had an last down candle, followed by a telltale signs of them moving upwards, right? They did what? They broke structure to do what? Retrace into an area for us to do what? Start buying. They bought. The following day, likewise, came. They took a buy. You see? Then, now, this is what I like, to have signs of the market changing for us. We can clearly see that the market broke to the downside. This could be a correction or a change of character, because we could say that, hey, the market is coming here to take a buy, right? That's when we have to do our analysis, right? We have to be clear in our trades and do our analysis. This thing, yeah, it's fine. Let me just say, this is our change of character. Our change of character, right? Because it broke to the downside, right? Because initially, what should have happened was the market should have kept on moving upwards here to take out these buy stops, but it failed to take out the buy stops, right? This is a telltale sign that we might have changed character, that we might be in a downtrend. And when it left an order block right here, right? And for us to see that we change character is when we have a break of structure here. Remember, change of character, it can be once because it shows that the market changed character, right? Now we have a break of structure. A break of structure, and it leaves clues for us. It leaves clues for us. So in future we know that we will be sellers in the market. Like for example here, we could have had our sell, but that sell wasn't as beautiful as we hoped it to be. The market went closely up here, right, to tap there to find our sell. Then remember, liquidity. We assumed that the market was going to push up, but we know that the market changed direction now. It changed direction. We are looking for sell opportunities now, right? So this could be our last up candle. This could be our last up candles. And look at that. The market the following day came, played around, then tapped to sell, giving us what? A break of a structure, right? In the zone. Give us a breakout structure. Our order block, right? Saying that when price comes into this area, we're going to be sellers in the market. Look how it took long, because what? It created liquidity. That's why we have to be so specific with our entries. Discipline, discipline. Because the market created liquidity for what? There to be taken out, right? Then the market left sell stops, right? This could be our target, our TP, right? Since we had an entry over here, our entry, and it's a sniper entry, zero drawdown. Our entry, stop loss maybe somewhere. I like my stop loss to be calculated around about 30 pips or so. Yeah, we can have a 30 pip stop loss. Stop loss somewhere here. Stop loss, entry, and our take profit over here. Our take profit over here, which that gives us in total a beautiful 180 pip run. As you can see, the market came, tapped it a bit. Mind you, it tapped it a bit, you see? Yeah. That's how we would have actually entered this trade. So that was an example of liquidity zones, order blocks. Yeah. Thank you for taking the time to view, and we'll continue on our next lesson to break it together and put it all together.